Good morning, everybody, and thank you very much indeed for joining this webinar this morning about the Aubrey Capital Management Global Emerging Markets Fund. For those of you who don't know us, and I guess that may be quite a number of you, there is an introductory slide on the screen at the moment which talks a little bit about Aubrey. Aubrey was founded by myself and 3 other partners in 2006. We launched our first fund, which is the Global Growth Fund, in 2007. And then in 2012, we started our Global Emerging Market Opportunities Fund, which is the entity that we're talking about today. All of our funds, or both of our main funds, are growth stock, index agnostic funds with very, very clear investment processes which we employ for both strategies. We're extremely experienced emerging market team. Myself and my 2 colleagues who manage the fund have been doing emerging markets and Asia for the thick end of 40 years in my case and about 30 in theirs, which really together makes us one of the most experienced emerging markets teams in Europe, I would suggest. The track record of the strategy goes back to 2012, and you can see on the bottom bullet point on this slide that over that time period, a very, very large time period now, we've delivered an annualized return of 9%. Against the 3.7% return for the MSCI Emerging Market Index. If ever there was a good advert for buying an active fund management strategy rather than an ETF, this surely must be it. The other thing to say is that our upside capture is about 97%, i.e. pretty much all the upside, and the downside capture is only 73%, which means that actually our strategy is relatively defensive whenever things get very tough in emerging markets, which from time to time they do. And of course, a lot of people regard emerging markets as being a very risky proposition. In our view, they're not particularly risky, but we'll talk a bit more about that as we go on. The team that looks after the Aubrey Emerging Market Strategy is highlighted here on this page with myself and my 2 main colleagues on either side of me. John Ewart and myself have been working together for really pretty much 20 years. He was a colleague of mine in my days at First State Investment. Rob Bruce and myself, we both lived in Hong Kong in the 1990s. And again, he has been working for Aubrey since 2015. So we've had a 10-year period together. Kleiser Lidman and Camelia Huang have been with us between 5 and 8 years, respectively. And then underneath, we have 3 in our London office, and 2 of them, John Alves and Ben Shields, operate a treetop global convertibles fund, which does a lot of work in Asia, and particularly Asian technology companies. And we draw on their extremely knowledgeable expertise to reinforce our strategy. What I should say about the team is that we don't silo people. We don't make people, for example, Camelia is Chinese, but we don't say to Camelia, you're only doing China because you're Chinese. All of us are analysts effectively, and we're all looking for the 30 to 35 best ideas that we can put into the fund at any one time. And we don't tell people that's your idea and it didn't work, that's your idea and it did work. We don't want that to happen. It's a broad approach. Everybody goes to all the meetings that come to the office. We travel a lot as well, of course. But the point is that we are entirely focused on getting the best 30 to 35 ideas into the portfolio at any given time. This is a track record that we've achieved since 2012 when we started. We started with a mandate from a big life company called Old Mutual, South African based but UK orientated. In 2012, they gave us $30 million roughly to invest in, and we turned it into a public fund in 2015, and they helped us with that by seeding it with the first 45 million. And we've grown it since then. And as you can see, it is a very different outcome to what you might get if you were in an emerging market ETF. And of course, in these days where passive investing is so fashionable, I would suggest that emerging markets is not a good place for using an ETF. We've achieved 151% outperformance, total return of 214%, which is massively better than the 60-odd% that you've had in the MSCI EM index. How do we do it? What do we do? Well, the first thing is that we focus very heavily on consumer. And by that, I mean a broad remit of consumer. So it's not just eat, drink, wear, wash, all the basic necessities. It actually encompasses anything that companies are providing that makes people's lives better, more convenient, more comfortable. Now, why are we doing this? Well, we're doing this because, as the map's suggesting here, half the world's population or more live in those dark blue countries on the map. The demographics are extremely favorable. 50% of the Indian population is under the age of 30. And apart from in China, where everyone knows people are getting older, generally speaking, it's a young, dynamic, hard-working, very upwardly mobile population. More and more people are moving to cities. And when people move to cities, they consume about 3 times as much as they do if they live in the countryside. And it's a really, really aspirational population. People want to get into a better place. Parents want their children to be better off than they were. And people are working hard to achieve that. So whether it's better food, whether it's better drink, whether it's better transport, instead of having a bicycle, you have a motorcycle. Instead of having a motorcycle, you have a car, owning your first property, having your first bank account. These are all the things that interest us. And why do we do this? We do this because so much of what happens in emerging markets is cyclical. To a very large extent, emerging markets are very energy dependent. And I don't know what the oil price will do this time next year. I don't know whether it'll be high or low or whatever. I don't know what the semiconductor cycle will be doing. I don't know what the US economy will be doing. And of course, there is still a good deal of export dependency in Asia. But what I do know for a fact is that there will be more Indians driving motorcycles this time next year, more Indians driving cars, more Indians owning their own property, and so forth. And this is the reason we do what we do, why we focus on the consumer, in the broader sense consumer, because it's very much more reliable, it's very much more forecastable, and very, very much makes the whole investment proposition much more reliable. And it's one reason, I think, or one of the many reasons why our downside capture ratio, which we talked about in slide 1 of 73%, is so much better than the index, because these are not deeply cyclical businesses. Once people are eating better food, they don't go back. Once people are riding a motorcycle, they don't go back to a bicycle, etc. It's a very much more reliable proposition, and it provides a tailwind blowing through our companies' portfolios, or our portfolio companies' businesses. They're just getting that constant upside of demand as people get richer. And I mean, why do we do this? Let's just try to graphically illustrate this. I mean, GDP per capita is not a bad yardstick or bad way to measure people's ability to consume. I mean, broadly speaking, as people get richer, they have more money. It's as simple as that. And you can sort of see that both China and India, obviously with different scales, because the China GDP per capita in the main cities is probably $25,000 a head, but over the whole country is about $12,500 a head. Whereas in India, the GDP per capita is only $2,500 a head. And so they're a long, long way behind in terms of ability to spend money. But it doesn't really matter where they are. The point is the trajectory, as you can see on the graph, is extremely steep from bottom left to top right. And that's what we like to see when we're looking at a country. Now, everybody talks about buying high quality companies, and so do we. We talk about high quality companies. Well, what do we define high quality companies as? Some people can be quite sort of vague about this. We're not vague at all. I mean, what we are saying when we define a high quality company, it has to meet these requirements before we are interested in it. And we forecast 2 years ahead and we model 3 years back. And we are looking for companies that are achieving a 15% return on equity, 15% earnings per share growth, and a 15% cash flow return on assets. Well, why the cash flow return on assets? Because we are growth investors and we want our companies to be generating enough cash to be able to invest in and grow their businesses going forward. And so these are the requirements that we need for our companies before we're interested in them. As I said earlier, we're index agnostic, and by and large, 80% of our return, our alpha in the portfolio is generated from stock selection. So this requirement to have high quality, profitable, cash generative companies is absolutely key. This is a very simple S-curve of what we regard as the demand potential in emerging markets. And just to explain the chart a little bit, on the y-axis in descending wealth order, we have Korea and Taiwan, which are not really emerging markets, to be fair, very wealthy countries. They're only emerging markets in MSCI stock market definition. But anyway, they are the richest, so they're up to the top of the y-axis, followed by China, descending as far as India, where GDP per capita is 2,500 per head. Now, this S-curve is a very reliable indicator of what people are doing at any stage of development. So in India, people are much more interested in good food, better clothing, getting their first house, their first flat, whatever it might be, maybe their first bank account. And it's only as they get richer that they're able to gravitate towards e-commerce, travel, healthcare. And whereas in China, at the other end of the scale, most people have got plenty to eat and plenty to drink. And so from our point of view as investors, we're more interested in the service sector in China. It doesn't mean to say we'd never buy a food and drink company in China. It just means to say that we think they're less interesting growth propositions than the service sector at the top, healthcare, wealth management, technology, etc. And actually over the years, particularly between about 2013 and 2020, we made a huge amount of money on e-commerce in China because as it became a really, really big part of the retail environment. And the final thing to say about this S-curve is it's terribly reliable. I mean, in fact, the e-commerce sector in India is just starting to develop as people get bank accounts and you get payment processes and so forth. People are able to shop online where they weren't able to do so 5 or 6 years ago. And so these things can develop very quickly and they can develop very reliably and it's very easy to forecast when it's going to start happening and get ahead of the game as an investor. So this is our stock selection process in its complete form. We have a watch list of 300 to 400 stocks, and that is developed from the universe. We think the universe of consumer companies is about 2,900 companies. And if you do a basic screen using our 15% ROE, 15% cash generation on assets, and 15% earnings growth, you come out at about 360 companies that we regard as our watch list. Now, a lot of these companies we will know extremely well already by virtue of the fact that we're very experienced and we've been looking at these markets for a very long time. We then do some much more detailed analysis on them. We try to talk to them, we try to visit them. We basically form what we call our focus list, which is about 150 stocks. And these are the ones out of the watch list that we think are really ones that we could buy at extremely short notice at any given time. And so again, we're doing our models, we're writing our company reports, we're talking to the company itself, we're trying to establish whether they are the best or the second best in their class, and they may well become the best in due course. And these are what we will regard as our soldiers who are ready to go into battle at short notice. And one of, I think, the edges that we have over some of our competitors probably is that we are a small team, but an experienced team, and we're able to move very, very quickly should we think it's right to do so within different countries in the emerging market universe. Which takes me on to the final bit, which is our macro asset allocation. And we're not trying to be supercharged Nobel laureate economists here. We are reviewing all of our countries on a quarterly basis, and we're really looking for the second derivative, i.e. is growth accelerating or is growth contracting and so forth. And is household wealth expanding? Are people feeling good? The most important part of it, however, is the first point there, politics. Because at the end of the day, we're looking for countries where there's a good feel-good factor, where people are feeling positive about life, where people want to go out and spend money. And if they're being governed badly, and they've got a miserable government in charge of them, they tend to hunker down and not spend money. And we don't want to be in countries like that. So we do take fairly aggressive positions on countries, quite often have nothing in quite substantial areas of the world or the emerging market universe, but it's worked well for us. I said 80% of our alpha is generated by stock selection, but that means 20% is done by asset allocation. And from time to time, it has been very important to our progress. So this is just illustrates what I have just been trying to explain, how we get from the universe. We think there's a universe, as I say, of about 2,800 odd companies, which we think qualify as consumer companies in the broader sense, consumer and technology with a consumer edge on it. And that 2,700 with our screen, our 15% screen, goes down to a bottom line there. You can see of 371. And then our focus list is the ones that we think are soldiers that we can buy at very short notice so that they're ready for battle. And so, we've got 40 odd companies in both India and China, so forth down. So if we want to go to Thailand in a hurry, we suddenly think that Thailand is good, that politics are improving, whatever it might be. We've got 6 companies that we can pick very quickly, and we might pick 2 or 3 of them straight away. but it won't take us months to make up our mind because we've done the work and the opportunity is there for us to take as and when we think it's appropriate. And the current portfolio comprises 33 stocks, and that is usually very typical between 30 and 35 holdings. And it's all very well me talking like this and telling you what we're after. As just to remind you yet again, we are after those 15%. Are we achieving them? Well, we certainly are. You can see that the return on equity in the portfolio is extremely high at 39%. Earnings per share growth is also exceptionally high. And one thing I haven't mentioned until now, which is important to us, is as growth stock investors, you can't expect to buy good growth companies at a cheap price earnings ratio. But what we're interested in is a price earnings to growth ratio. And so if we think the growth in the stock justifies a high PE, it doesn't matter to us. But our kind of sort of stop level, our limit on that is 1.5. So if a company is trading at 30 times earnings and it's growing at 20%, it's okay. It's 1.5 times price earnings divided by growth. But if it's much more than that, we're very, very careful. But we are forecasting 2 years out, so it might not be this year, but it could be next year. And so that is our valuation kind of limit where we stop in terms of buying stocks. But I do think I'm standing in Germany, where an appreciation of quality is always very, very acute in my view. I mean, you don't buy a Porsche for nothing. In emerging markets, you don't buy a good company for nothing either. You actually have to pay reasonable multiples for good companies. But from our point of view, it's as long as the growth is justifying that multiple, that's fine. We'll pay up for it. And then the final thing to say just on this chart is that the average market cap is pretty high at the moment. It's probably a little bit higher than usual because we have got some big technology companies in the portfolio at the moment. But you can also see that the middle company, the median company, has got actually net cash in the balance sheet. Minus 16% means it's got cash, net cash. And I think only 11 out of our 33 companies in the portfolio have any debt at all. So these are extremely profitable companies, very cash generative companies, growing very strongly. And they're not growing their earnings by gearing the balance sheet because they've got fortress-like balance sheets as well. Why do we sell things? Well, chiefly, if I'm honest with you, point 2 is what matters most to us, I think. Portfolio renewal. There's always competition for capital in the portfolio. And we have a kind of reserves bench like any football manager, and we have stocks that we would be very happy to buy at short notice, and we will make changes if we think there's a better opportunity. We try to look at the portfolio companies with a clean sheet of paper mentality. Fund managers tend to give favoritism to companies they already own, but we try to say, if we didn't own this stock now, would we buy it? And if the answer is no, then there's a reasonably good chance that it becomes a source of cash. The valuation I talked about a bit in the last slide, a price earnings ratio, a price earnings to growth ratio of less than 1.5 is important. If it gets much higher than that, we will take a bit of profit. It doesn't mean to say we necessarily sell the position, but it means that it is up for review, put it that way. We have a maximum limit of 45 stocks in the portfolio, but we've never been anywhere near that. We do have a maximum weighting of 7% because with the exception of Taiwan Semiconductor, which is 10% of the MSCI Emerging Market Index, and we currently own about 7% in TSMC, it is a fact that if a 7% weighting goes wrong on you, it can really spoil your quarter, if not your year. And so we tend to start a position of between 2 and 2.5%, and if it gets to 4 or 5%, there's a pretty good chance we will be taking some profit on the way up. And we, generally speaking, are fully invested with no cash in the portfolio. This is where we've been over the course of our history since 2012. And you can see that the pink in the bottom is perhaps the most interesting one to talk to, which is India. Before Prime Minister Modi came to power, we only had one holding in India. And then we got the idea that he was going to come to power, that it would be very, very good for the Indian market. And so within about 3 weeks, we went from having one holding to having 8 holdings, and about 30% of the fund committed to the Indian market. And we've kind of, you can see, more or less kept it that way or more ever since. And that was an incredibly good decision. And I spoke earlier about our edge, our ability to make decisions quickly. We had our Indian focus list of companies that we could pick from, and we were able to pick 7 or 8 companies extremely quickly, and didn't take us 3 months to have multiple committee meetings and get to the right decision, which was very much the right decision. You can also see on the yellow bit in the middle, for the first 3 years of the strategy's existence, we had no holdings in Latin America. Again, I think that was extremely beneficial to performance. And you can also see in the middle of the blue where we've had from time to time huge weightings in China. And if I'm honest with you, one of the things that went wrong for us between end of 2021 and middle of 2023 is we kept too much in China, when China continued to lock down its population and continued to have very, very stiff restrictions. And everyone thought, well, China is going to unlock like the rest of the world, but it never did. And meanwhile, the property market went seriously wrong, and it was a very expensive spell for the portfolio. I mean, not relatively, it wasn't a disaster, but it was quite a big drawdown. So where are we now? Well, we're about 30%. This is a little bit out of date. It's the June 30th makeup, but we're in sort of 33% roughly in China, 27% in India. We've got a bit more in Latin America than usual, because actually there's some quite good opportunities there at the moment. And I said earlier that we are consumer facing, but it's not a consumer portfolio. You can see the consumer discretion and the consumer services parts of the portfolio are obviously a very material part of it, but equally we do cover 6 other sectors, and in total 8 different sectors. And as I say, here we are where we are with the portfolio at the moment, about equal weighted between China and India. The Singapore bit is not really Singapore. It's 2 e-commerce operators that are headquartered in Singapore. They actually trade as listed companies in America as ADRs, but they are Singapore headquartered. And Taiwan is basically TSMC plus 2 other holdings, technology-ish and financial holdings. And Brazil, as I said earlier, has become a more material part of the portfolio this year, as we found more things to do in Latin America. The top 10, I always hope when people look at this that they see quite a lot of companies that they don't necessarily know, because the standard emerging market portfolio is very, very predictable, with lots and lots and lots in TSMC and Tencent and Samsung Electronics and all the other seriously big companies in the index. And we've got a few of those now. I guess we've got TSMC, obviously. Mercado Libre, funny enough, is not in the emerging market index. I don't think it's a Brazilian equivalent of Amazon stroke eBay, and is doing extremely well. Most of these companies, you can see that our top 10 is 42% of the portfolio. Most of them have got to those sort of size positions because they've done really very well. Xiaomi is one of China's leading mobile telephone makers. They also make an extremely good electric car. We're a bit careful about electric cars in China because there are so many people who make electric cars, but Xiaomi's one appears to be doing extremely well. Sea Limited is like the Amazon of Southeast Asia. And Tencent is like the Facebook of China. I mean, people use Tencent for everything, for mobile banking, for taxi summoning, for social media, etc., etc. It's just a sort of kind of, it's the way people work in China. Max Healthcare, number 9 there, is a Indian private healthcare provider. The Indian public healthcare sector is very, very poor and difficult, but as people get richer in India, they take out health insurance policies and go to private hospitals. And Max Healthcare has a national chain of hospitals doing extremely good business. And the one on the bottom too also quite interests me, because we bought it about a year ago after I'd been to India. It's called Interglobe Aviation. It's trades as Indigo. It's India's leading airline, and they have nearly 400 airplanes. They complete 2,000 routes per day, and it's a sort of low-cost, reasonably good service airline with very nice new airplanes, all Airbuses. And air travel in India is becoming just very, very achievable now. You can fly from Delhi to Bombay for about the same price as a first-class rail ticket, and the rail ticket will take you 18 hours, and the airplane, even with a not very efficient Indian airport, will take you 3 or 4 hours. So it's growing at about 11% a year top line. It's got a 64% share of the Indian airline market, and it's just a very, very good operation indeed. So that's where we are. It's an active share, as we suggested at the start. The total active share at the moment is 78%. It's usually a bit higher than that, in fact, but that's just where it is now. And here is the performance. Well, 13 years is quite a long time now, and you can see that we've had, if you count them up, we've had 8 years when we've outperformed and 5 years when we've underperformed. But I would suggest strongly that if you look at the numbers, the volatility is very much to the upside, with the 8 good years massively outperforming, and the less good years, in some cases, quite marginally underperforming. And as I said earlier, I put that down a lot to the fact that a lot of our companies are much less cyclical. They're much more consistent businesses. They're much more predictable, forecastable, and secure, really. And that's why I think a lot of people come to emerging markets thinking it's going to be terribly risky and terribly difficult. But if you do it this way, in our experience, it works very, very nicely. So where are we in terms of an outlook? Well, I mean, of course, it's not been an asset class that people have been very positive about for a long time, and it's underperformed America hugely. It's underperformed most places hugely, and it's just basically been difficult. And China has made it particularly difficult in the last 4 or 5 years. Actually, there are quite a lot of things going their way, I think, at the moment. I mean, the emerging market valuations are very attractive at the moment, particularly the Chinese ones. The market has done quite well this year, but there are still very, very attractive, nicely valued companies in China. The Indian market is having a bit of a consolidation this year, but in our view, the Indian market is the best long-term investment destination pretty much in the world outside America. The government is right on the side of businesses. It's very nationalist. It's very, very much India first. It's deregulating. It's improving the economic environment massively. My colleague Rob Brewer has just come back from India last week and exceptionally positive about the propositions there. But having said that, the market has been a bit flat this year, which is frustrating. But it's, we mustn't be too short term about these things. But above all else, one of the things that really helps emerging markets is the strength or weakness of the dollar. This is because a lot of emerging market currencies are tied or either formally or semi-tied to the US dollar. And so if rates are coming down in America and the dollar is weakening, it allows their countries, their central banks, to drop their own rates and to improve liquidity and to not worry so much about their currency losing a lot of value against the dollar. If the dollar's coming down, they can do the same, improving their competitiveness and so forth. The oil price is also key to emerging markets, and particularly in the case of India. For most of my career, the Indian inflation rate has been running at about 8 to 12%, I would say. It's only in the last 4 or 5 years that it started to come down to reasonable levels, and currently it's running at 2.8%. Indian interest rates are running at 5.5% at the moment, so there's quite a lot of opportunity for them to come down. They've had a good monsoon as well, which is important for food prices. So a low oil price is very beneficial for all of Asia. Excuse me, because Asian countries all import oil, and it matters. And in India's case, unfortunately, they have obviously been importing Russian oil, which is not ideal, but it's been good for their economy. But a low oil price, a weaker dollar, valuations are attractive. The politics, by and large, are improving pretty well. The Indian politics are good. Chinese, they've had their spats with the business community in China. It appears that they've sort of put that to bed. The private sector in China employs 85% of people in China, and so the government can't afford to fall out with them too much or destroy their businesses, because they're going to end up with a very dissatisfied population. The cash flow returns on the portfolio are extremely strong at the moment. The valuations have rarely been lower. As I've indicated at the start, I think relative to America, relative to Europe, possibly even Japan, the emerging markets look extremely promising, I think, at the moment, and I think very little downside from here. So that's the end of the presentation, and I don't know whether there are any questions. There's a screen on my right, which I'm hoping may show a question if there is one from somebody. I could take you to an appendix or two if you wanted. Just show 1 or 2 things. I mean, this is our strategy in green, which compared with the S&P 500, compared with Europe, compared with others, it's I would suggest to you it's not a bad place to be if you're looking to diversify out of very mainstream markets. These are our sectors. As I say, we've always been in quite a number of sectors, but obviously consumer discretionary and consumer staples are our biggest ones. The turnover of the fund has just had a question popped up. Thank you. The turnover of the fund, it varies really. I mean, if I go back to, I'm not going to go back, but if you can recall the asset allocation slide, where, for example, we had nothing in India to speak of, one holding, and then we went to 30%. If you have a moment like that in the portfolio, it can be really fairly material, the turnover. It averages out at about 50% overall. We do, as I say, we model 3 years back, we forecast 2 years forward. We hope to keep companies for at least 2 years, but you have to be flexible and you have to be adaptable. So being in Edinburgh, here we go. Do you have much access to management teams? Well, that is a very helpful question, because the answer to that is unequivocally yes. We have very, very good access. We have much better access in Edinburgh than we would have if we were in London. I tell you why, because there are about 6 very serious emerging market operators in Edinburgh, and we're probably the 6th. And when an Asian company comes to Britain on a roadshow, it invariably comes to Edinburgh, and if it wants to make a day of it, which they do, they pretty much invite all 6. Now, if we were the size we are, we have about 600 million in emerging market strategy, but if we were that size in London, we wouldn't be top of the queue at all. In fact, we'd be well down the batting order. But we do get a lot of access. Before lockdown, we were reckoning we had about 190 companies a year came through our office in Edinburgh, added to which we do travel, as I said. My colleague Rob's just come back from India. My colleague Camelia was in China for a month in April. And I was in India last September, and so forth. We try to sort of keep a rolling roadshow program going, as well as seeing companies when they come to town. Sorry, what holdings are you most optimistic about? Well, if it depends on your short term or long term. The question is, what companies am I most optimistic about? I think, I mean, again, I don't want to be too short term about this, and so I'm going to say it's got to be some of these Indian companies. I think that Indigo Airline, for example, is to touch back on that. I mean, when Mr. Modi came to power, I think there were 12 or 13 airports in India. There are now 34. There were only 3 international airports, Calcutta, Delhi, and Bombay. Now there are 16 that fly abroad, and the Indians are traveling in Asia and into the Gulf and into Britain and so forth. And the outlook for the Indian airline industry, I think, is absolutely fantastic, despite the unfortunate crash that we had back in June, I think, in Ahmedabad. So that's one. I mean, some of the other Indian companies, I mean, there's a company called Bharti Airtel, which we own, which is the largest mobile telephone provider. 5 years ago, there were 300 million Indians with mobile telephones. It's now 800 million and just growing at a prodigious pace. And when you go to India now, you can sort of see that mobile telephones are just simply, they're not a luxury. Everyone has one, and everyone is shopping online, and everyone is doing that sort of thing. There's another Indian company called Zomato, which does quick commerce. Everyone in India orders their breakfast every day on Zomato. They use the Zomato app on their telephone. There's a local store, a Zomato store. They get the eggs, bread, yogurt together, give it to somebody on a motorcycle, and it's with you in 5 minutes. What's not to like? And this is just becoming just a sort of kind of massive phenomenon in India. And it's only really possible in India because the delivery costs are pretty much zero, because of the fellow on the motorbike doesn't cost anything very much. No, I mean, so those are sort of 3 Indian ones. I think probably some of the Taiwanese technology companies. I mean, TSMC, of course, is a sort of total sort of has a sort of huge lock on the entire semiconductor market. It's been a great company, very, very well run, very well managed, still only on 18 times earnings. Very happy holders of that. I mean, there are just lots of companies I'm very optimistic about. So I'm struggling to think of other ones, but I think chiefly the Indian ones are just just are the ones that really float my boat in the sort of medium to long term. They just look very, very promising prospects to me. So I think that sounds like we've got all the questions we needed. Yeah, just to finish on the e-commerce thing, I think I mentioned earlier that we made a lot of money in China between 2012 and 2020. And you can sort of see the yellow line there is the Chinese e-commerce penetration. When we started the fund in 2012, it was only about sort of 7 or 8% of retail sales, and it's now 35%. And I talked about that S-curve earlier, how predictable it is that other countries follow the same pattern. I mean, of course, it all started in America, gravitated to Europe, and now into China, and now into India. You can see India, the light blue line at the bottom. It's just beginning to become a seriously exciting sector in India, and it's propelled by the prevalence of mobile telephones and the fact that they've now got a payment system and a settlement system and a delivery system, and all these ingredients are there now. And so I think that's going to be the next area where e-commerce is going to really take off. You know, a couple of e-commerce companies. Eternal, that is Zomato, the one I talked about, the grocery, online grocery company. And Mercado Libre is just an enormous sort of Amazon stroke eBay of South America. It does compete with Amazon head to head. It also competes with Sea Limited, with the one we own for Southeast Asia, but it's very, very much dominant in South America. So there we go. I think that's all I've got to say. So for those of you who stayed with me, thank you very much indeed for doing so. And I would welcome any feedback by telephone or email or whatever else might be your preferred mode of communication. Thank you very much indeed.